much for joining me for today's episode of A Lesson in Real Estate. My name is Kay Thompson, and today we're going to be discussing mortgage interest rates. Now, there is a lot of talk going on in the real estate industry right now regarding the interest rates for mortgages. And on top of that, there are other things that are in heavy rotation for discussing. That includes the housing inventory. It also includes rent and mortgage payment moratoriums, both things that we'll most likely cover on other episodes. Today, though, I thought it would be very wise of us to discuss the mortgage rates, because if you are in the market to purchase a home, then you're probably looking at a lot of different information that says now is a great time to buy or refinance because the mortgage rates are so low. And that's actually true, and that's true nationwide, and it has been the case for, I would say, at least the last year or so. So, in most times and in most cases, you hear that, but really and truly, what does that mean to you? In today's lesson, we will discuss the different kinds of mortgage rates, interest rates that you may hear about or that you may see information on. And I will provide definitions for those different types of mortgage rates and share with you what it means for your mortgage payment and home ownership. So let's just start by defining and identifying the different types of rates there are that will affect your mortgage. The first one is just the standard mortgage interest rate, which most people hear about. Most people, especially first-time home buyers, when they're out shopping, that's the thing that they hear from most people that they should be focused on. What is going to be your interest rate? And that's absolutely true. That is one of the things that you should, in fact, focus on. So there's a wonderful website called thebalance.com where you can go and get the definition that I'm about to share with you and other great definitions as well regarding a mortgage. And so the definition from thebalance.com is as follows. The mortgage interest rate is what it costs you each month to finance your property. It's an extra amount that you must pay to your lender in addition to paying off the amount that you've already borrowed. Your interest rate is effectively the lender's compensation or payment for letting you use its money to purchase your property. So a lot of us don't realize that, or we're not thinking about it, even if we've heard it somewhere, that mortgages that are produced by financial institutions are basically monies that they have taken in or collected from their existing customers, and then they in turn loan that money to you for you to make purchases for housing, automobiles, college, businesses, whatever that is, and then they charge you a premium, I would say, for making that loan with them. And so the interest rate that you're paying is that premium that you're being billed to get this money. So the next term that we're going to look at, and I think it's one that most people don't think about so much when they're purchasing a home, and that is your annual percentage rate. And usually when you are in the process or in the throes with the lender, they're going to give you what they call a certificate of disclosure. For those of you who have purchased a home before, you're thinking, I've never heard of that. It's actually the data that they show you as far as how much it's going to cost you to borrow the money after you've made your application for a loan and been pre-approved. And so for a lot of us, we would call that back in the day a HUD-1 statement. So just know going forward that your HUD-1 statement and the certificate of disclosure is really in essence the same information. So what is an annual percentage rate? An annual percentage rate is actually a broader measure of the cost of borrowing money than the interest rate, because the APR, as it is often called, reflects the interest rate that you're paying for the mortgage, any points that you're paying, which we'll talk about a little bit later, the mortgage broker fees, because mortgage brokers and lenders have to be paid as well, in addition to other charges that you may get and have to pay for in order to be able to secure the loan. For that reason, your APR is usually a little bit higher than your interest rate. So So basically, the APR is going to include not only your mortgage interest rate, but it's also going to have a number that includes the fees and other charges that you would get from your lender. So your lender may charge you to originate the loan, which is basically meaning they're going to charge you to be able to set the loan up in their system so that they can be able to service it. They are paying you for working, or charging you, I should say, not paying you, but charging you for working with a specific lender. The lender gets a commission or a portion, or paid a portion based on the loan amount that they make to you, just like your real estate agent is. And then there are other things that you can do too. And so, one thing in particular, like I said, we'll talk about a little bit later, is points, and all of that's involved in the annual percentage rate, or APR. So it is very important to look at that information too when you're talking to a lender, because you want to know what they're charging you for. What specific things is your lender tacking on and charging you for to get the money? And that's, you know, in addition to that just like I said, that payment for having the luxury of being able to borrow from them in the first place. Now, we have a fixed annual percentage rate, which is what most people want. And you also, I also want to say here that most people also prefer to have a fixed mortgage interest rate. And so I'm going to give you a quick definition of what a fixed annual percentage rate is, and then we'll talk a little bit more about that afterwards. So the term fixed mortgage rate, as defined by Investopedia, which is one of my all-time favorite sites as well, for finding out information regarding financing and, you know, how to use your money effectively and to develop wealth and things of that nature. If you're a novice at a lot of things as it relates to finance, Investopedia is a wonderful site. They explain pretty much everything on the site in layman's terms. You have to be just literate, meaning you have to be able to understand the words that you're reading in order to be able to, you know, figure out what they're talking about. So I picked this term for that reason, or this definition, I should say, for that reason from Investopedia. And it goes like this. So the term fixed rate mortgage refers to a home that has a fixed interest rate for the entire term of the loan. This means that the mortgage carries a constant interest rate from beginning to end. Terms on these type of loans can range anywhere from 10 years to 30 years for fixed rate mortgages, and that is very popular for consumers who want to know how much they'll pay every month. So if you're in a position as a first-time home buyer or a repeat home buyer, what have you, to make a purchase for a home, and you don't have a lot of resources to be able to handle, say, an adjustable rate mortgage, which we'll talk about next, then you definitely want to be able to secure a fixed annual percentage rate and a fixed mortgage rate, because what that's going to do is that's going to secure the thought for you that your mortgage payment will remain the same throughout the life of the loan. Now, when it comes to changes in your mortgage payment, there are other things that can affect that. So I want to be able to put this caveat here so that you understand. Your interest rate may not change, but your so that means your interest rate that you're paying on the money isn't going to change, but your tax rate could change for your city, county, or state, depending on how your taxes are calculated for your particular area that you're living in on real property. And also your insurance payment could change. Your insurance could go up or down depending on varying things as well. And so if you're in a situation, which I hope that most people would be in this situation, where you have a mortgage payment that has an escrow account attached to it, which is something that I discussed in a previous episode. But if you have an escrow account, then what your mortgage company is doing is they're taking out a specific amount for taxes and insurance, and they're putting that to the side to be able to pay those things for you when the time comes. And so before they make a change to your payment on a fixed interest rate. They're going to send out a statement to you, usually, specifically if you have some sort of government-backed funding, that says, hey, you know, we reviewed your escrow account, and based on, you know, your taxes and the insurance premium information that we got from your insurance carrier, we're going to either have to increase your mortgage payment because we have a shortage in your escrow account, or we're going to decrease your payment because there's a surplus. And in the case that there's a surplus, a lot of times the mortgage company will send you a check in the mail for the difference. And if that happens, then I usually tell people to just send that check right back and tell them to apply towards your principal payment, or your principal balance, I should say, so that your principal balance can go down, and that is going to help you pay off the mortgage sooner. I'm just making a few principal payments extra a year can shave a lots of time off of the length of time that you have to, you know, pay your mortgage back. So that's very important. Next, we will define amortization, and also with this definition, I'm taking from one of my favorite websites, Investopedia, to give a proper definition for this term that most people can understand. And so Investopedia refers to the term as meaning an accounting technique used to periodically lower the book value of a loan or intangible asset over a period of time. In relation to a loan, amortization focuses on spreading out loan payments over time. And when applied to an asset, amortization is similar to depreciation, which is something that we'll talk about definitely in another episode. So basically what amortization is it's an accounting technique that is used to be able to show you over time how much you're going to pay. And it's going to include the interest rate that you're paying, the adjustable or not adjustable rate, but the annual percentage rate that you're paying as well. And what they'll do is use specific calculations. One, I'll show you actually a very basic a very basic formula for calculating interest rates later in the show that will show you, you know, just how much money could be going towards your principal payment and how much you're paying towards interest. Now, if you're looking at an amortization schedule, you can probably find an example of one on the internet. In fact, not probably, I'm sure that you can. And if you're a homeowner currently and you have access to your mortgage documents, you probably find more often than not an amortization schedule in there. The amortization schedule actually shows you, you know, how much your payments would be from starting from payment one. And I'm just going to say on a 3-year or 30-year mortgage, you have 360 payments if it's a monthly mortgage. And so it's going to show you how much principal, interest, taxes are going to be going towards are going to be deducted, and how much of that is going to be applied towards those things, I should say, from your payment until you get down to the very last payment. And you'll notice that when you get to, on a 30-year amortization schedule, when you get to year 15 in the schedule, that's typically when most of your things kind of get reversed. If you're looking at the first 15 years, the bulk of the payments that they're taking out is going towards interest because, of course, the lender wants to get their money up front. And so then on the second half or the last 15 years, more and more of the money that you're paying from your payment will go towards the principal balance. And so amortization schedules usually change after the first couple of payments, and they're sometimes they cannot be valid because sometimes we pay a little bit more than we and you know then the amortization schedule says that we should, and if we do that, then that throws it off. Or if you're paying a little bit less or you're paying late, your mortgage company is typically charging you mortgage interest by the day. So let's just say, and they're charging that to you up front. So if you're late 7 days, then you're paying extra interest, or more interest is going to go towards that because you're actually outside of the schedule that they have set up for you to make timely payments. So they're going to charge you more interest, and that will throw your amortization schedule off. So most people don't even pay attention to the amortization schedule after they have received it from the closing attorney or the closing agent at closing. But it is something that will give you a pretty good idea of how much you're going to pay in all to borrow the money that you needed for your mortgage. So now that we've gotten the definitions out of the way, let us now discuss how you can use this information to determine, which loan rates are best for you and your family and your situation. Like I said before just now, amortization plays a really, really big role in trying to figure that out. And here are some other things that you can do to make sure that you're getting the biggest bang for your buck when it comes to a mortgage. The first thing that you want to do is figure out how much you can afford. Now, a lot of times, most of us don't think about most of us don't think about how much, we can afford on our own. We kind of leave that up to a lender. Typically, lenders will loan you up to 3.5 times the amount of your monthly, or not monthly, but your annual earnings. So if you're earning $30,000 a year, chances are you could get a mortgage somewhere around $100,000 to $150,000. But those numbers do not take into account what you have as expenses. That amount will be deducted, and as in a debt to income ratio scenario, and it could affect how much you're actually able to borrow. So, you can figure that out yourself. There's lots of different websites. Investopedia is one. Bankrate is another one where you can kind of figure out how much money that you would need, that you could borrow based on your situation. The best way to determine that, though, is to go and speak to a lender about it. One of the things that I do want to point out here is that a lot of times different lenders have different criteria that they use. There's a basis for getting any government-backed funding that all of them have to adhere to, but in an effort to mitigate the possibility for loss for lenders, they put an extra layer sometimes of requirements on top of what the government says that they have to adhere to in order to be sure that they're making sound investments. So you definitely want to look at how much you can afford, and you can either do that yourself, like I said, by going to sites like www.bankrate.com to figure that out. You can also just talk to a lender about it based on their different rules and criteria that they have. How much would they be able to, give you a loan for based on your situation? The next thing that I strongly urge everyone to do, even though we have programs in most states where people can get, help and assistance with the down payments, and, even the idea that you can negotiate with a seller for closing costs. All of those things really depend on, the market that you're in, the availability of those down payment assistance funds, and, the seller situation, for negotiation. So, keeping that in mind, I usually tell people to save as much as you can up front. So how much do I save? Well, I would say start with between 4 and 6% of the amount that you want to, the purchase price that you want to borrow. So if you are looking to purchase a $100,000 home, and I'm just using round numbers here just to make it easier for everyone. So if you're looking to purchase a $100,000 home, you're going to want to be able to save for closing costs and a down payment. So if you're getting an FHA loan, where the most that FHA will give you for the loan is $96,500. This is for $100,000. You would need to come up with $3,500 as a down payment in order to make that $96,500 $100,000. So you would need the $3,500. And then usually for closing costs on the low end, you may pay, 2 to 3% closing costs. On the high end, you may pay 4 to 6%. So I would say save between another $4,000 to $6,000 to be able to handle the closing costs at the end. And the closing cost is going to include all of those things that I said before when we were talking about the APR, or the annual percentage rate. You're going to pay the loan origination fees. You're going to pay your closing attorney. You're probably going to have to pay taxes and insurance up for the first year. You're going to do all of that at closing. So that is part of what the 4 to 6% of the purchase price is going to go to for closing costs. So in all, I would say on $100,000, if you're not looking to get any money through negotiations with the seller for closing costs, and if you're not going to be using down payment assistance, you will probably need to save between $7,000 and $10,000 in order to purchase this $100,000 home. Next, you want to consider the length of time that you have on a mortgage. So let's talk about that. Most people are like, oh, you know, I don't want to spend 30 years paying a mortgage. Most of us don't, to be honest. Most of us don't want to spend that amount of time paying for a mortgage. But it really can save you a lot in interest if you have a shorter mortgage payment. Now, to keep yourself within the constraints of your monthly payment for budget, you can pay more upfront. There's something called points that you can pay, where you can pay down your interest rate. Usually and typically, to pay down 0.25% of an interest rate, you would need $1,000, and that is going to be one of those upfront costs that you have to pay. So let's just say your interest rate was 2.25%, and you wanted to pay it down to 2%. Well, you could throw an extra $1,000 into your closing costs to pay down the points, and that would go towards that. And so instead of having a 2.25% interest rate, you would have a 2% interest rate. If you wanted to pay down 1 full point, of course, you would need about $4,000. And that's kind of standard across the board. So those are some of the things that you want to look at. It's very important that you choose the right type of mortgage. It is very easy to, well, it's not very easy, but it's most feasible for people to get a 30-year mortgage and try to pay it off in less time. The reason why is because, you know, even though you're paying more interest over the life of the loan, if you're able to make those few interest or few principal payments, as I was stating earlier, then you can shave years off of the amount of time that you have to pay the loan off, thus saving yourself that interest. So if you want to have a lower monthly interest, mortgage payment, then the longer you can stretch out your term, the better. And then if you can pay it off early, great. Usually on government-backed loans, there is no prepayment penalty for early prepayment, so that should work. And then you want to shop around for your mortgage like you shop around for shoes. You want to talk to several different mortgage lenders. You want to ask them what criteria they're using to approve or deny mortgages. You want to ask them what interest rates they're working from. You want to ask them, you know, about the different loan products that they have. You want to ask them if they participate in down payment assistance programs and things of that nature. There are certain lenders that make certain types of loans and other lenders that don't. A prime example would be the FHA 203K loan, which is a loan that actually individual homeowners can take advantage of. It allows you to purchase a property and make certain repairs to the property while you're in the process of getting the loan. And every lender does not service that type of loan, and every lender doesn't offer that. So you want to make sure that you're getting a complete picture of the full suite of loan products that the lender offers, so that you can know which one is right for you. Now, if you do these things, chances are you will wind up finding the mortgage that's best for you and your family and your situation, and you will put yourself on a path to home ownership and generational wealth that can last throughout your lifetime and that of your posterity. And I just wanted to finish this up with giving you an idea of what how to calculate interest payments on an amortization schedule. So we're going to go ahead and continue to use the $100,000 loan amount, because like I said, that's a round number and it's easier for people to wrap their heads around round numbers or you know, rounded numbers. So we're going to have a loan amount of $100,000. The loan term is going to be 12 months, and I just use that so we can keep the numbers small. And our interest rate is going to be 2.25%. So in order to figure out what you would be what your amortization schedule would be on 12 months, you would take the $100,000, which is the loan amount, and you will multiply that by 2.25%, which is going to give you 250. So 2,250. You're going to take that 2,250 because that's going to be your interest payment for the year. You're going to divide that by 12, and it's going to tell you how much interest you're paying per month from your loan payment. So in this case, $2,250 divided by 12 is $187.50. And the $187.50 is going to be the amount that's going to be deducted from your loan to cover the cost of the interest, which is what you're paying back to the lender for borrowing the money. Now, if you have a monthly mortgage payment on $100,000 of $1,000, which is actually 10% or 1% of the amount that you're borrowing, you're going to take that $1,000. You're going to deduct the $187.50. That's going to leave you with $812.50. That amount, part of it, is going to be applied towards your principal and the escrow account for taxes and insurance. So we're not even going to discuss taxes and insurance for the purposes of this program. We're just talking about the interest. So if you take that $812.50 and we apply that, all of that towards the mortgage payment, then it's going to leave you with a balance of $99,187.50 instead of a balance of, I think if you take away the $1,000, it would be $99,000 even. So it's going to leave you with a little bit less. It's just showing you how much money is actually going to be left to pay the balance, to pay off the mortgage, if you were to keep going in that direction. So the lender is going to take $187.50 off top from your payment in this particular scenario, and that balance of $99,187.50 is going to be what's left for you to pay off. And then the next month they'll take the same steps from your new payment. So they'll take $99,187.50, and they would, and then they would multiply that times 2.25%, which is your interest rate, and so forth and so on. So that is all that we have for you today. I hope that this information that I've provided is going to be able to put you on a path to finding out and digging a little deeper about what you would be getting yourself into and how the numbers work in terms of mortgages. If you have any other questions and concerns about that, please feel free to reach out to me. Until next time, I'd like to thank you for joining us. My name is Kay Thompson, and this has been A Lesson in Real Estate. Until next time, guys, take care of yourself and stay safe out there. Bye now.